continued caution for most investors. You know, if you're in relative value, if in arbitrage, this is a great environment for you. If you're an agile day trader, that's fine. If you're a long-term investor looking to put money to work, I would wait. And it's not just because of the economics, which we know is concerning because of the sudden stops, the supply and demand disruptions and destructions we're seeing. Carl, we started seeing today more market stress, more liquidity stress. Yesterday it was just the credit market and the inflation market. Today it got to the treasury market. So be careful out there is what I tell people.
Where does that go, that stress? I mean, how bad are things looking in places like the treasury market and the credit market?
So bad enough for the New York Fed to announce a massive increase in repo. So clearly they finally paid attention. They finally are looking at the technicals. So bad enough for that. Look, the concern you have is you don't want a feedback loop. The economy disrupts the markets, and then market malfunction disrupts the economy. We don't want that second loop, because if that second loop kicks in, and I really hope it doesn't, but if it kicks in, it's going to make things a lot harder for policy to act as a circuit breaker. And we're all looking for policy to act as circuit breakers.
It's that kind of urgency, though, Mohamed, the lack of it, that's keeping some of these policy proposals on the Hill, at least, from getting bipartisan support. Thinking of Grassley and payroll tax holiday today. How much urgency do you need to get response?
So I like what I'm hearing in terms of its multi-phase, whole of government. That's great. I also like that the initial focus is going to be on timely and targeted. Remember, the 50 basis points cut did nothing. It arguably made things worse because general policy responses right now are not going to reactivate the economy. They'll help balance sheet, but not reactivate the economy. What we need urgently is two things. One is more resources to the medical side. That's the true circuit breaker for the economy. Give people confidence that the virus will be contained, and give people confidence in immunity. And secondly, focus on the most vulnerable segments, especially the one with systemic risks. That is where all the phase one should be. And then phase two can be more general. And then have the Fed look at market malfunctioning and make sure it does not spread.
What is the moment for you? What is the news headline for you that you would sound more upbeat and that you would say, OK, maybe now's the time to do some buying?
Well, let me first talk about the bottoming out of the economy, because that matters for the technical one, the one that we don't like. A disorderly move down that establishes finally the basis for the bounce back up. That's a technical one. And the journey there, Sarah, as you know, is a very unsettling journey for most people.
How much of Italy's experience, Mohamed, is coloring your view of what's headed our way, at least from a public health standpoint?
So I think whether it's Italy, whether it's Boeing, and we can talk about Boeing, whether it's Seattle, these are all extremes. But what they've done for the markets is they've given us some sense of what the left tail, what the really bad scenario looks like. Italy has two issues that scare those of us who talk to the medical professionals. One is that it spreads really quickly. Deaths went up, Carl, by 31% today, daily deaths. This thing spreads really quickly. Two, it's a demonstration effect to the rest of Europe that social distancing, shutting down the whole country, is now a precedent in Europe, which means for economic terms, you paralyze economic activity. So this notion of an economic sudden stop becomes exportable to other parts of Europe. So I view it as helping you understand the left tail. The problem with markets is once they understand the left tail better, they start pricing it. And I think we saw a bit of that today as well.